The stock of the day is brought to you by IG, Australia's #1 CFD provider. With over 17,000 markets and extended trading hours, turn US earnings season volatility into opportunity. Get started at IG.com.
And stock of the day is GQG Partners, the investment boutique. It's hit record funds under management of $155.5 billion US for the half year. That's up almost 50% from the same period last year. Chief Executive Tim Carver has attributed the jump to strong investment performance and positive net inflows, with those inflows coming in at $11.1 billion US for the period. Net income standing at $201.2 million US. That's up more than 56%. The company will pay a dividend of 5.6 cents a share. That's up more than 46% for the half-year period. So, in fact, the stock off a little today, but we take a look more broadly. It has experienced some stellar growth more generally. So, Luke, still calling itself a boutique. Can it really? A true definition of a boutique is sort of a small shop, isn't it? No longer small.
Yeah, I wouldn't consider this one a boutique anymore. It's actually a very different fund manager. I've looked at this a couple of times now as a suggestion on the call, and every time I have, I sort of get reminded. It's gets compared to a Magellan, a Platinum, and a Regal, a few of the ones we're familiar with on the Aussie market. But these guys do it a little bit differently, and the best way you can see that if you look at their results today. Only a very, very small proportion of their income comes from performance fees, and that's despite their funds performing very, very well, as the CEO highlighted before, Andrew. They, rather than being one of those classic 2 and 20 hedge fund style managers, these guys have really, really low base management fees, almost no performance fees, more akin almost to sort of an ETF style investor. And I think that's what's really insulated them from a lot of the pain you've seen their peers suffer. There's been a lot of fee compression amongst their peers, but these guys starting at the lower end where it's around sort of backworking from their results today, somewhere between sort of 25, 30 basis points is sort of their average management fee. That means that you can grow your fund quite strongly from these institutional allocators who are looking for that broad exposure, low cost, and obviously good performance as well. I've said it's a buy before on the program. The shares have done really well, but it's only been backed by this operational performance, which continues quite strongly. Even today, still trades on 13, 14 times earnings. You're not paying a steep price. My only worry with it is trees don't grow to the sky, particularly in equity strategies. $150 billion is a lot of money to manage in I know they do some other stuff, but primarily equity strategies. There's only sort of 50 to 100 companies that are in their investable universe that have the size and liquidity required for those sorts of that fund level and portfolio. But nonetheless, the tailwinds are with them. The valuation's good. I'll say it's a hold for the program, but I do really respect what these guys have done. They've approached the industry in a very different way to some of their peers. I think they've really reaped the rewards because of that. And it's good to see the share price reflecting that as well. Just given the run and that valuation. Last time I think it was about 10 times earnings. Now you're up towards that 13, 14. Let's say a hold. But like I said, I really respect what they're doing.
All right. So, Andrew, Luke has covered this before. Have you taken a good look at this before?
I've never taken a very close look. It always feels like a bit of a cop-out for a stock picker to scrutinise fund managers too much. It feels a bit like cheating if you're managing your own capital. But yeah, as Luke said, you got to take your hat off, right? Like they've had a stellar track record with their performance. I'm just hearing Luke talk there. I was reminded of the Bezos quote of, your margin is my opportunity, and the challenger that's able to sort of come in and offer much lower fees, it's going to attract a bunch of funds under management. And that's really the key metric that you want to look at here. And it's hard to argue with the direction that that's going. 14 doesn't seem too onerous. As a PE, the only thing to bear in mind is that funds under management and fund flows can be volatile. It's going to be a direct reflection of what's happening on markets and the sentiment that's out there amongst investors. And we know that investors and markets are extraordinarily fickle. It's not a bad thing. It's just accepting and understanding that's what it is. So you will see a little bit of movement from time to time. And again, as we said before, the market can overreact to those kinds of situations. But I'm really struggling to find too much to not like here. It's sort of well run. profits going in the right direction. Valuation multiple doesn't seem too excessive. So I'll go with a hold only by virtue of the fact that I haven't done the deep dive on it, but it certainly looks interesting.
All right, so both positive on GQG, but at this stage, it is a double hold. That's our stock of the day.
The stock of the day was brought to you by IG. Turn volatility into opportunity this US earnings season with extended trading hours on over 110 key US shares. Get started at IG.com.